Hello, everyone, and welcome to our December commentary. Thank you all for joining us today. In the spirit of Giving Tuesday, which was just yesterday, we know there are many different reasons, why individuals and families are charitably inclined. But today we really wanted to put, a financial lens on it, on charitable giving there, specifically the key strategies and, considerations for really aligning your financial accounts with your charitable goals in a way that benefits, both you and the organizations that you support really in the most optimal way. And today, I'm joined as well with both, Austin and Evan. And, we're really excited to kind of walk through these strategies with you. If you've joined us for our previous monthly commentaries, we also post these. They are recorded and post these on our YouTube channel. So if you do need to step away before we wrap up here, these will be recorded and posted usually by end of week by as well. We kind of host these every single month here as well, with the goal of really providing, timely education, really serving as a resource and trying to rotate topics as well on what we're hearing from both, our current clients and prospective clients as, areas of topics of interest. But with that, let's take a look at what we'll be covering today on the agenda. So we'll have, really actions, what we can do today in terms of charitable giving, also some legacy considerations, and also at the end, we'll touch on some Q&A. So again, you'll have the Q&A box below. So if any questions do come up as we're speaking here, make sure you put those in there. You don't want to forget, we'll touch on those at the end as well. Like I mentioned, so we'll take a look at some actions today and really touch on, first and foremost, what qualifies as a tax deductible charity. And that's really, anything that's recognized by the IRS as a 501c3 tax exempt, group there. It really operates as, approved for charitable purposes, operates exclusively for, various purposes of public welfare there. Like I mentioned, all those on the left, education, hospitals, basically just for human welfare, animal welfare, things of charitable nature, things that are not eligible, things like political campaigns, individuals, family members, as much as we wish, they are a charitable donation, they're not. And something we also think, most foreign charities, unless they're US recognized by an IRS charity, but you can always look online to see if they are. There is, online, there is a website you can go to, but most will, recognize themselves as a 501c3 company or charity there. Something that did come out just to be aware of for next year that you can take advantage of through, the One Big Beautiful Bill Act is, starting next year for non-itemizers, you can go ahead and for any cash donations that you do, you can deduct those as an above the line donation up to, single filers, $1,000 and jointly as well, $2,000. And that actually doesn't have a sunset like some of the other provisions in there. So as of right now, that's 2026 and beyond. So make sure to, keep receipts, things like that if you are donating cash, next year as well. And for itemizers there, on the flip side, if you do donate to charity, they're going to have an additional floor to that, much like some medical expenses if you itemize. And that floor is going to be, 0.5% of your adjusted gross income. And just as an example there, if your adjusted gross income as a couple is $200,000, that first thousand that you donate to charity is not going to be, added on to your itemized deductions. So you have to be over that first thousand, and then it would count towards your itemized deductions there.
And just to pitch in here quickly, this is a $1,000, $2,000 for the above the line deduction next year. I think it's a good place to start. But the reason this got put in is there was a big blowback during the when this tax law was initially put in, that raising the standard deduction really hurt charities because it didn't benefit people as much to be donating money, because historically you've had to itemize to count your charitable donation as a deduction. And now for a joint couple, when there's a $30,000 standard deduction, uh, unless you have significant other deductions, you could have a retired couple, they have their house paid off, so they don't have property taxes, things like, or they have property taxes, but not, mortgage insurance, things like that, mortgage interest. And maybe they were donating 10, $15,000, but it's still not getting them over that $30,000 hump to actually get the benefit of that. And so that was hurting charities because people weren't donating as much because they didn't get the tax benefit of it. Uh, Now this is like I said, it's relatively small to start with, $1,000 for single, 2,000 joint. But it's nice that even if you don't itemize, you'll still get some of that benefit for giving a charity. So hopefully that helps increase the overall gifting to charity again. So sorry, Amanda, for cutting in
No.
there, but I'll pass it back to you here.
Yeah, no, and of course, like Austin mentioned, definitely hurt when they put that in there. Next, we'll touch on something called QCDs, which are qualified charitable distributions. And really, you can take advantage of those when you turn the age of 70 and a half from your, think traditional IRAs, those pre-tax accounts that you have. And this is from your IRAs as well, not from your 401ks or your TSPs, just to have that out there too. But essentially, with qualified charitable distributions, you can take, a distribution from your IRA directly to the charity. So it does have to be made directly to the charity, not to yourself first, and then to the charity. But you can take that and, that's directly excluded as, taxable income to you in the year that you do that here. So that's especially valuable, if you're taking the standard deduction, you're not taking advantage of, itemizing, that you take a distribution, you can automatically have, that distribution be not taxable. When normally, right, you're paying state, also local tax, or state and federal taxes on that. So one thing that you can do instead of just paying cash on that is do a QCD. Also, when you do turn, R&D age, required minimum distribution age, this can really be powerful because a lot of the times the clients we work with, they really don't need sometimes all the amounts that they are required to take, when they get that age. So a lot of the times they would take the extra that they don't need, and turn that around into charity so that, they are not bumped up into additional tax brackets there. If the annual limit there, if you really want to be charitably inclined, you can donate up to, $108,000. And that's per person, by the way. So, and that's per year and it's adjusted annually with inflation. But it's definitely something that a lot of our clients, do take advantage of is, donating directly from their IRA to charities there.
Yeah, and Amanda, you said this, but just to emphasize the point, because I know a lot of the people that are going to be listening to this have the TSP. And this is the qualified charitable distributions are not something that you can do from the TSP, right? These have to be done from an IRA. So typically when we're doing this with clients, it's money that has, maybe a portion of or all of the TSP has been rolled into an IRA, and then they're doing these qualified distributions from there. So great. Thanks, Amanda.
Yeah. And
Yeah.
I'll kick it off to Evan, yeah, to talk about stock there.
So QCDs are a great strategy out of your IRAs, but what about some strategies for your non-retirement accounts? One strategy is to donate the appreciated stock or the appreciated funds straight from the non-retirement account to the charity. And the benefit of doing that is you don't pay any capital gains tax. So if you had, let's say you invested 10,000 to a non-retirement account, it appreciated to 20,000. If you were to liquidate that account, realize the gains, you need to pay capital gains tax on that 10,000 of growth, typically 15% on the Fed side, versus if you donate that straight to the charity, they don't need to pay the capital gains tax on that, and you get a deduction for doing that charitable giving. So in that same example, the 10,000 appreciated to 20,000, you actually can deduct 20,000 if you're an itemized deductor, up to 30% of your AGI. But let's say it's what you donated is more than 30% of your AGI. You take that 30% deduction that year, but then you're able to carry the excess donations forward for the next 5 years. So very powerful strategy where if you're charitably inclined, number one, the charity gets a tax benefit, but number two, if you're itemizing, you get a nice itemized deduction. One additional strategy on top of that is instead of donating those appreciated stocks or appreciated funds straight to the charity, you can put those appreciated stocks or appreciated funds into a donor advised fund. And the main benefit of that is you get to distribute those charitable donations over time. So let's say, for example, there was 100,000 worth of appreciated stock or funds. Instead of being forced to send that all to one charity in 1 year, you put that 100,000 to a donor advised fund. You still get that full deduction for that year and the carried forward if it's more than 30% of your AGI. But the main benefit of the donor advised fund is you can decide where those donations go to in the future, whether it's one charity over time or various charities. You want to change the charities over time. That's the main benefit of the donor advised fund. And that's something that we can do with our clients on our end. And one more
Yeah.
additional strategy, sorry, Austin. One more additional
No.
strategy is another thing that we do with our clients is we're doing a lot of Roth conversions. So if you have a big donation into a donor advised fund 1 year, that's more of a conversion that we can do that year because it's lowering your taxable income.
Yeah, the donor advised funds can be a great tool. They almost act um, like your own, what is it, like your own foundation, right? You know how
Yeah.
sometimes really wealthy people can they have a foundation and they give money to the foundation and but then that foundation can distribute that money to different places. Like that, the donor advised fund is like your own personal foundation. Um, and for people that have these big uh gains, we've got I know we work with some people who have they've owned some company for forever, right? Maybe it was a company they worked for and they've got huge gains in that and every time they sell it, you're getting you have to pay taxes on that. Well, if you're in that position, it doesn't make any sense you're giving charitably. It doesn't make any sense to be just giving away cash when you could be giving away that appreciated stock, right? And getting the benefit of not paying the taxes on that, um, and getting the deduction. It's like a double whammy on that. So that's a pretty amazing benefit. So so far we've talked about what you can be doing while you're living, right? You want to make a gift this year. What makes the most sense? Do I want to give it from just cash? Do I want to give it from an IRA as a qualified charitable distribution, a QCD? Do I want to give it from my stock, give an appreciated stock position? And the summary there is if you are over 70 and a half and have an IRA, or you have a non-retirement investment account with appreciated stock positions, or both of those things, and you are charitably inclined and want to be giving to charity, writing a check should be the last thing on your list, the last way to do that, right? There's going to be potentially other ways that could be more beneficial. So that was the goal of sharing those ideas there is just saying, hey, there's other ways to give if you're already giving that can be a little more beneficial. Now, additionally, in addition to just giving while you're living, you also may want to leave a legacy, right? You may want to leave money behind to charity, and that's what we'll talk about here briefly next. So when you do that, when you leave money to charity, it's just like leaving it to an individual. You can write it into your will. They can be a beneficiary on an account. You can have a charity as a beneficiary. You can have a charity as a beneficiary of a trust. right? And you can do that in different ways. You could say, here's a specific amount. I want to give a specific amount to this charity and this charity and this charity. It could be a percentage of your account. Really, all the options that you have to name an individual person, you can also have a charity be part of that for your estate. Now, one thing just kind of a story here is in the past I was working with a client who early in their career they they hadn't looked at their beneficiaries on their accounts for since earlier in their career. Okay, and they had always been passionate about animals, and so they had a local animal like a rescue facility, right, in as a beneficiary on their 401k, and it was a 20% beneficiary. Now, when they were young, they had started doing the 401k, and maybe it was a $50,000 account, $100,000 account, a 20% beneficiary. Sure, that's fine. Well, now this is 30 years later. They have $1 million plus 401k, and all of a sudden, because they had that 20% beneficiary, if they would have passed away, this animal clinic would have gotten a $200,000 plus donation. Now that's great if that's what you intend to do. But in this case, they just hadn't thought about it, and they now they have kids, right? And they're like, yeah, my kids probably wouldn't be super happy if the animal clinic got 20% of my estate when now that probably would have gone to them. So what they did is they switched it to a dollar amount gift. They still wanted to give, right? But it wasn't going to be tied to a percentage anymore. So especially when we're thinking about charities, things like this that maybe aren't direct family members. Maybe you do want to have a big portion of your estate go to charity, but it's always good to just double check these things. I mean, this is a good thing no matter what. Double check your beneficiaries, your estate plan, make sure it's all the way you want it. But additionally, with charities, it's important to double check, like our last bullet item here, double check that you're using their current legal name, tax ID number. Those things can change sometimes. So just double check that those are all up to date. Double check that the numbers are right. And then the other thing, and this is just a little tip, I guess, that if you if you're the type of person that wants to support a handful or more of charities or beneficiaries, sometimes that's where a trust really can be beneficial. Uh, Having a trust where you can say you can update one document to then update all of your beneficiaries rather than trying to go to every account that you have and then updating all of the beneficiaries on every account every time you want to add or remove a beneficiary. Just a tip there if that's something you want to do and support a lot of different causes uh, as a legacy. Now, another thing to think about here, and this is really important, but it's really overlooked as well, is the tax efficiency of donating various types of accounts when you pass. Okay, so when you pass away and an account goes through your estate, as most of you know, different accounts get different tax treatment to the people that inherit them. So if you are in a position where you want to give some money to charity and also some money to individual people, not every account is created equally in terms of tax efficiency. Okay. So let's start with traditional retirement accounts. So this would be like your traditional TSP. Maybe you've rolled that into an IRA. Maybe you have a traditional IRA. This is tax deferred accounts. So these are accounts that when you take distributions from, you have to pay taxes on. Okay. Now, if those accounts go to an individual person, that person now has to pay taxes on those. If they're not your spouse, they have to take the account out over 10 years. They have a 10-year timeline to take the account out, pay taxes on it. Well, an income tax, not capital gains tax, income tax. If an IRA goes to a charity, they don't have to pay taxes on it, right? So, giving money or bequeathing money to charity, having money to go to charity through your estate from an IRA is a pretty efficient way to do it because it means nobody had to pay tax on it. Okay. let's go down one level here to a non-retirement account. So this is just not a retirement account. It's just a general investment account. In this type of account, generally, uh, you invest, money grows. Then if you use the money, you pay taxes on the gains, right? That's a non-retirement account. If a non-retirement account passes through your estate, your beneficiaries get the benefit of what's called a step up in basis. So let's say you have that position from earlier in your career. You bought it for $10,000. Now it's worth $100,000. When that passes to an individual through your estate, the basis, it's as if they purchased it for the value on the date that you died. So their basis is $100,000. They don't have to pay any taxable gains if they sell that right then. The only gains that they would have to pay is if it grew beyond that point. Okay, if they, you passed it on at $100,000 and it grows to 120, then they sold it. Now they've got to pay taxes on that amount. So donating this money, you can see why that's not as maybe beneficial. It's not as tax efficient because when you pass that on to your heirs, they actually would not have had to pay taxes on that gain like they would have from the traditional IRA. Okay. And then Evan, did you have a look like you were about
Yeah, I was
to
going to
pitch in
say,
there?
and a good strategy there is why not donate those funds before you pass, and then you get the deduction on your taxes. Not a huge benefit, but still a better strategy than waiting until you pass to donate those to a charity.
Yep. Yep. Great thought. Um, and then the third type here, the least tax efficient, not to say it's a bad idea to donate it, right? But the least tax efficient would be Roth assets. Okay. So Roth assets, Roth IRA, Roth TSP, when those pass to an individual beneficiary, they don't have to pay taxes on it, right? If it goes to a spouse, they get to take it out over your lifetime. If it goes to a non-spouse, they have 10 years of tax-free growth. So passing, if you have both uh, individuals and charities, having your Roth money go to the charity really doesn't make sense because the individuals would get much of a much greater tax benefit from that. So what happens in a lot of cases is if somebody says, I want to give 10% of my estate to charity, what happens is it goes proportionately. 10% of my traditional, 10% of my non-retirement, 10% of my Roth, 10% of every account's going to charity. That doesn't make as much sense as saying, okay, I want 10% of my estate to go to charity. Well, let's figure out the dollar amounts on that and send more to charity from my traditional IRA so that nobody has to pay taxes on that. Give more of my Roth and my non-retirement account to my individual beneficiaries, and um, and then they don't have to have the tax burden of paying on the traditional assets. So not to say here that as an individual it's bad to receive traditional IRA. Nobody's going to complain about receiving inheritance and having to pay tax on it, right? It's not a bad thing to give Roth money to charity, right? But this is just looking at what's the most efficient path. Okay, so this is something that's not talked about enough, I think, when it comes to giving money away in charity. Now, the last thing I have here, and I'll just very briefly cover this. These are some advanced charitable planning strategies. So, what we've talked about so far is all pretty accessible, right? Applies to most people or most charitably inclined people. There's a couple strategies involving trusts that are for more unique circumstances or a lot of times at much higher asset levels. When you are wanting to remove money from your personal estate, these used to be more utilized when the estate tax exemptions were lower. Like right now, you can pass, what is it, 15, $16 million
Per person.
per person through your estate without any estate taxes. So it's not, again, but well, I still want to talk through these. So there are a couple types of trusts: charitable lead trust, charitable remainder trust, charitable gift annuity. And essentially, what these allow you to do is um, either make a large gift now to a charity that then you or some other beneficiary gets income from for the rest of their life. So, but then the remainder of it. So, say you had you wanted to give $1 million to charity, but you wanted the income from that to come and support you or your spouse or a loved one, right? You would give that $1 million in a lump sum now, get some tax benefit from that. You would receive income back from the trust, and then whatever's left over from that amount goes to charity at the end of your life. That removes the $1 million from your estate now, which is the goal from that, but it still gives you some income. That's one. You can also kind of do it the other way around, where you make a gift to a person and the charity gets the benefit during the lifetime. So there's different ways to structure this, but again, without going fully into depth on these, the idea is these are ways to kind of make a big lump sum while also getting some income from that is usually the goal for these more advanced strategies. And at the same time, a lot of times it involves removing money from your estate is part of the goal there. So we're gonna wrap up there and move to some questions, to some Q&A. So I saw there were a handful of people that joined throughout the presentation today. Just so you know, Amanda said this at the beginning, but this will be posted on our YouTube channel, just like all the rest of these that we've been doing. So if you missed the beginning, go back and watch it on YouTube. We'll have that up hopefully by the end of the week. The other thing that I wanted to say is if you are enjoying these, like we post a lot more than just these on our YouTube channel. So if you're enjoying this type of content and you've just been waiting to get the emails from us for these monthly commentaries or presentations, I'd really recommend subscribing to the YouTube channel. And that way you'll get notified whenever we post content. We do a lot of, these are all longer, 30-minute presentations, but we do a lot of 5 to 10 minute segments on different things that could be valuable to you. So definitely check that out on the YouTube page. And but for those of you that are on, there have been no questions posted in the Q&A box. So either we did a really good job at explaining all this, or you're keeping things to yourself.
Yeah.
Um, so I'm just gonna walk through this real quick, and as you guys think of questions, put them in there. But if anybody's on this call who's not a client of ours, I'm looking through and I see some clients here on the attendee list. But if anybody's on that's not a client, uh, something that we offer, you'll see us talk about this a lot. We have a retirement readiness call. It's complimentary. It's free. For anybody who's attended one of our webinars, you get one of these for free during your career, and it's a chance to talk to us. Me, Evan, Amanda, Neil, one of our other advisors, coaches, and we can really talk through just about anything. If one of these charitable giving things triggered something and that sounds interesting to you, we can talk about that. We also cover a gamut of just making sure you are in good shape for retirement. Are your contributions going to the right place? Are you utilizing Roth or traditional accounts the right way? Are you ready to start taking distributions when you need to start taking those in retirement? So we can cover just about any of these things if you're interested. You can go to retfed.com/register or scan this QR code and book that complimentary call.